Hello and welcome to the 13th episode of the Mindful Wealth podcast. We're excited to have Karen Ho as our guest today. She's an American anthropologist who's done a lot of research into the Wall Street culture. And just to kick us off, can you tell us a little bit about who you are, what you do, where you come from, and how you got into this research?
Well, thanks for having me. I'm Karen Ho. I'm a social cultural anthropologist, and I study the culture of finance and Wall Street, and it's actually their relationship to socioeconomic inequality. For a long time, I've actually conducted field work with investment banks, with investment bankers and investment banks, to sort of understand their larger influence in the larger social economy.
Thank you, Karen. So maybe you could just start off by telling us, in your book, Liquidated, you argue that Wall Street culture is a driver for the negative aspects of the current moment of investor capitalism. I wonder if you could unpack that for us a little bit.
Yes, no, that's a great question. So for the past 40 years, Wall Street ideas, values, et cetera, have really shaped and catalyzed a focus on short-term shareholder value. And short-term shareholder value has actually been directly linked to the corresponding disinvestment and deferral and redistribution, right, of investment from or to stakeholders, other stakeholders, such as employees, communities, et cetera. So the corresponding focus on short-term shareholder value has actually led to the corresponding disinvestment in especially other stakeholders, especially employees and employment. So, for example, long-term stable jobs. Many of the sort of profits and accumulation that used to cohere to multiple stakeholders really has been drawn into and redistributed upwards, right, to shareholders. So it's not only that larger worldview, but also that short-termism that sets the stage for increasing inequality, right? And that we sort of see with this particular framing or this particular implementation of investor capitalism.
And I guess, like, as a follow-up question, I'm curious that you pull on the cultural aspects of that, because it strikes me that it's possible to make kind of like an economics sort of an argument there. So how is it that you kind of put culture, like the culture of Wall Street, at the start of that causal chain?
Yeah, no, that's a great question. So, you're talking to an anthropologist here, and so, my understanding of how the economy, the larger social economy works, is that it's always already cultural. That there actually isn't a separation, either academically or in the world, between economy and society. So back to that sort of question about investor-driven capitalism. General Electric, in the wake of the Great Depression, didn't fire a single employee. And that's because it was not because the economy was in good shape, right? The economy was in shambles, but it was culturally unthinkable to actually fire employees. It was a key cultural value. And part of what short-term shareholder value has done is that the value is about the sort of larger narrative and the larger worldview that it's to shareholders that the corporation is for. And that is a cultural decision, right? There's nothing in a corporate charter that says everything about an institution has to go towards the shareholders, right? And it's also a historical narrative. So in the mid-20th century, that was not the sort of dominant ideology. That was not the dominant business value. So therefore, we didn't, fire everybody at any chance we got. So the idea that the profits all cohere to the shareholders is itself a cultural value.
So I think there was something that occurred late 70s, early 80s, where we got really worried about inflation and the price of goods. And when we got really worried about inflation and the price of goods, that entered globalization, deregulation. How do we make it so that the end user, the consumer in the American economy, has that benefit? So I definitely see what you're saying about the benefits accruing to the investing class. But isn't there also a corollary benefit that goes to the consumer? And I think that if you listen to Harvard economist Don Boudreaux, as an example, he would say, no, it's been really, really positive, this thing that happened. And I'm wondering if you could speak to that just for a second.
Yeah, wow, that's a great question. So, consumers are oftentimes the tug of war here, right?
Yeah.
To sort of showcase, wow, you can sort of order Amazon Prime and things will be at your doorstep in 2 seconds. The sort of point that sort of I want to make here is that it's not necessarily either one way or the other. And that globalization and particular kinds of deregulations, re-regulations are also cultural decisions, right? These are not sort of inevitable processes that just happen to us, but rather, and this goes back to the to shareholding, is that if we're actually regulating today for financial markets. Right, so we have deregulation, but also regulation for particular policies to happen, and so the sort of offshoots for consumption, we could say that yes, the many consumers, especially if you're well resourced, have many choices. On the other hand, the kind of short-termism has actually, and multiple consumer choices, even though of course that's also contested because there's also monopolies, right? So we might say we're 50 different companies, but we're all still, the same, Gap and Co. or whatever it is. But that kind of short-termism in terms of products actually often undermines long-term productivity. So, one of the sort of favorite quotations I like to give in terms of Harvard Business School professors is Clayton Christensen, right? So he actually writes, a few years ago in the Harvard Business Review about the capitalist dilemma and about how short-term driven investor capitalism actually is bad for capitalists, right? It's actually bad for capital. Well, I shouldn't say it's bad for capitalists, but it's bad for capitalism. Because the short-termism actually undermines the long-term productivity and investment we actually need for market-driving innovations. And so to sort of use a sports analogy, even though I'm not an athlete, what short-term shareholder value has done, I think, to larger corporations and institutions is that we are forcing or catalyzing or shaping institutions to constantly run sprints. Right? Constantly run sprints, extract short-term shareholder value, get the latest spike. And that means the corporation never finishes the marathon.
So do you think that that has happened, given the fact that, and I realize that the last 10 years is short, but if you look at the last 100 years, it seems like productivity is up. It seems like, corporate US has been incredibly successful. And maybe that's because they've run a series of sprints and been successful in each of the sprints. And right now we're tiring out. But it seems like it's worked on the total big picture aggregate wealth creation level, while it's also at the same time created inequality that is unsustainable theoretically.
Yeah, so I think that sort of the overall wealth creation, and certainly if we sort of put inequality into that picture, right? Overall wealth creation sort of takes a different tone when we certainly take into account inequality, but also planetary instability. Right? So, when we count GDP, for example, or larger wealth accumulation, we're not necessarily always taking into account the fact that there are probably going to be, X times more fires, right, in California than there are today. The fact that there are, upwards of 70 million people displaced, right, because of conflict, climate change, right, that comes out of, one could argue, a kind of economic mindset, right, that doesn't take into account, right, the sort of longue durée, attendant consequences of accumulation, right? So, yeah.
So if I just kind of like reframe this a little bit, I know that this is a criticism that often gets leveled against like our political processes with elections every 4 or 5 years, depending, right? Which is that a certain government has a very short time to appeal to voters, and then they have a very short time to enact their policies. And 2 years into their mandate, they're immediately pitching for the next election. And so might we like kind of draw sort of a parallel there where it's as if this acceleration of shareholder interest forces like want to always be pitching to the next election kind of thing economically?
Yeah, no, I think that's a great analogy. Also, when corporations are understood and implemented in practice as if they were mainly a stock price, right? Or mainly a holding in a portfolio, which needs to change over, right? The holding a portfolio time frame is pretty short in sort of the longue durée, context. And so if one is always putting corporations themselves up for sale, right? Whether for a private equity portfolio or whether for a larger, fund management, turnover, et cetera, then the kinds of decisions that get made are going to be shaped by that short-termism.
Mm-hmm.
So you're sort of, in a sense, designing for the latest economic fashion, right? And oftentimes playing hot potato, as opposed to thinking about what can we build or what can we invest in and what are the sort of long-term people and planetary consequences that can come out of that.
Is that, I mean, I know that that's like that's the key factor in an analysis, but I think that there's more and more, especially with millennials starting to invest, that there's more and more conversation around, what does this company do? How do they do it? How do they treat their employees? How do they treat the earth? I mean, there's way more of that. And I think it's always been there, but it's been muted. And now it's like center stage. Maybe that's current political environment, but it strikes me as a privilege that we can have the conversation and that the conversation becomes so awesome. Because if we were in Haiti, we wouldn't be able to have this conversation. This conversation would not, inequality is a thing, but it's nowhere near the thing there. It's a huge thing here. And so we have this conversation. Does that make sense?
It does. And I like the fact that you bring up the investor democracy, because I do think that, folks, now that we do have a sort of investor privileged, capitalist economy, right? That investors then actually have a greater voice, right? And now one could argue that individual investors actually have sort of, a less powerful voice, because most of the voice is about is institutional investors, right? So how do we sort of lay shape to that? But to the extent that investors today really want to use their influence to actually have multiple values in there that corporations need to be attendant to. So in a sense, we can't take for granted what a shareholder's values are, right? And that's actually a good thing. If we can actually think about, well, what if values are about inequality or the environment or sustainability? That then, let's not sort of put a priori what a shareholder value is, right? We can shape that from an investor standpoint. At the same time, that sort of short-termism where one sort of extracts the greatest sort of price share does continue to be sort of a big factor here.
And I wonder, like, if we can just sort of, go back to the comment that Jonathan made about, the consumer, right? Because I think the fact is like that the consumer is also a worker. And so I think that's kind of the tension there, because on the one hand, like I guess the paradox that we see is, okay, so there's now, I mean, here in Canada, we call it Dollarama, but there's like the dollar store, right? Where like everybody can buy a bunch of cheap stuff. And like, I remember when you used to have to pay $15 for a pot or a spatula, but now you can get it for $1, right? So on the one hand, there's like a consumer buying power that's gone up, but on the other hand, in a wage reality, people's lives have sort of gotten more precarious and like less financially stable.
That's correct. So wages have really sort of stayed stagnant over the past 40 to 50 years, right? So in terms of, the sort of, larger aggregate measures. So that's actually something really, problematic, that we have wages really sort of declining or staying stable. And certainly how institutions are no longer have in their purview, right, jobs and employment, right? So jobs and employment actually used to be a key part of corporate governance, right? But if corporations are understood mainly to be beholden to shareholders, then jobs and employment are actually outside of that larger understanding of what a corporation is for. So corporations are not in the business of providing long-term stable jobs and benefits, right? So we do have an erosion of what we have sort of have formerly called middle class and working class jobs. So, and to take a quick tangent to this, I know we're going to get to this in a little bit. It's also important to sort of understand historically that many of these, good jobs, right, these corporate ladder jobs, which are now being dismantled or increasingly being dismantled, were also previously, excluded, right, from many people of color and women.
But let me just kind of throw something else in there. I mean, what do you make of globalization in this? Because I think it's one thing to have a domestic policy discussion where one talks about there is within, like, let's say the closed sphere that is the United States, or I'm in Canada, so that this closed sphere that is the Canadian labor market, right? And then the fact that at a certain point labor markets got deregulated in the sense that we allowed jobs to be offshored, so that there's been a negative consequence, let's say in the Canadian or the American middle class job sector. But if you look at that on a world scale, I wonder what happens when in India or China or Indonesia or Pakistan, there are living wage jobs that are being created there to the detriment of the American middle class. I wonder if you think that's a kind of a worthwhile avenue to interpret this with.
I think the sort of larger conversation with globalization now is so fraught, right? In terms of, it oftentimes becomes sort of rendered as a inevitable process, right? Where folks are sort of pit against each other. And I do think that many of the sort of advancement processes that you're talking about, right? We cannot limit it to these sort of, sort of constructed national boundaries. At the same time, who's pit against whom and why, I think we'll have to sort of deserves more unpacking. And just to give sort of, one example of this is that, it's actually quite interesting in terms of, an example from India with Tata Motors, right? So Tata Motors, for example, used to, and this is actually has a lot of parallels with the US, actually used to really focus on longue durée middle class positions. And part of Tata Motors' move in the past 20 years or so to shareholder value has itself rendered a lot of the formerly really stable middle class jobs in India much more precarious, right? So how these larger institutions influence one another is a key part of the story that can be just as important as, what's happening with sort of work, et cetera. Part of making their ratio look better is that cultural decision to outsource jobs. So it's not just a question of globalization, but also what are the sort of parameters through which we're making decisions about what looks good on our balance sheets.
So we're going off script here, and I love it. And this is good, but I want to go off script a little further. So I have this, I have this theory that I've just sort of bantered about, talked with friends about. It's sort of inside baseball kind of conversation, and it's you can't marry capital. I mean, underlying everything that we're talking about is capital, whether we like it or not, unless you're Cuba or China or North Korea. It's probably some other examples. Capital can go wherever capital wants to go. So we generally have to attract capital. And capital is picky. Capital wants a return on its investment. And we can be, the democratic investors can choose, hey, sustainability is important. Same-sex partner rights is important. We can actually talk about these things as social things, but capital decides where it's going to go. And that's, how do we manage that without losing the attraction that the US has for capital?
I often like to go back to one really sort of pivotal example that sort of I learned from conducting fieldwork amongst Wall Street investment bankers. And that's when a group of investment bankers were actually talking to me about a deal that they were currently on. And at the time, the deal was the fanciest mergers and acquisitions, in the world almost. And that was the M&A between Time Warner and AOL.
Yep.
And many of the bankers who talked to me said, oh my God, this deal sucks.
Yeah, it's a disaster to begin with.
Exactly. But, not only is our institution, really going to exact sort of windfall fees from this, right, on the order of 40 to $50 million, but that we actually need to push this through into the market because it's going to crash. Right. And again, this was happening around, 2001. So the idea that, yes, capital is attracted to this, but they also know that the AOL Time Warner merger is a terrible deal that does not have long-term sustainability. Right. So we could sort of say, yes, capital was attracted to that, but that doesn't make it a good decision for the world, but also for us in the long run. Right? It was not necessarily attractive for AOL Time Warner most employees. It wasn't necessarily attractive for them as institutions. So I think it's really important to render specific the measure that we use for capital's decisions.
Absolutely. I mean, I totally agree that capital is stupid as hell, right? No question. But it chooses, and we have to. And I use this word, this is intentionally, we have to, it's like bow to it a little bit in order to not be Haiti, to not be a third world country. Like, and I think that's an interesting conundrum we face ourselves. We face as a culture. We want to actually be more equal. But we also want to attract capital. And so how do we, I think this is kind of what you're talking about, is how do we have it both ways?
Right, right. Well, I think capital would have been much better used, right? It, but I think that to sort of make it just an issue of attraction, right? As opposed to, there are particular policies, there are particular regulations, there are particular worldviews and values that have to be in place for capital to be attracted and mobilized in this manner, right? We could attract and mobilize capital in other ways. So we don't want to sort of let the drive and the sort of attraction of capital sort of render invisible, right, the larger policies or the alternatives that could happen with large amounts of money.
Yeah. And I mean, I think if we kind of like move this back to the sphere of anthropology, and like, I feel like what, I really enjoyed about like reading your work, Karen, is just this fact of maybe bringing like some of these economic decisions where we talk about capital, or we talk about the market and the market decides or capital decides. Well, ultimately, when we abstract those things from the humans who are pushing on the button behind them, we risk making it seem like a state of nature as opposed to it being a state of culture. And so I wonder if you could just like, explain that to us a little bit more deeply, because I feel like that was like one of the really, cool things that I found about Liquidated, is that it really made me think, well, yeah, I mean, we're always, us who are in, the financial sphere, we end up talking about the market as if it's like the weather, right? But ultimately, like, there are rules that govern the market. Those are cultural and political. And then there are attitudes that govern people's behaviors within the market, and that's cultural. So
That's right. That's right. That was so well stated that I couldn't have stated it better myself. So the idea that markets are always already cultural and social, that's something that certainly imbues my training and how I think about and approach markets and economy. But specifically, financial markets are often framed as the sort of penultimate kind or type of market, right? That is oftentimes also framed as acultural, right? What goes up must come down, autonomous, naturalized, etc. So really thinking about the particularity and unpacking the individuals, institutions, how folks actually get socialized into this world or set of worlds and values, and then empowered to do what they do, was a key part of what I wanted to understand. Because short-term shareholder value was not something that had always happened, right? Institutions were much more long-term. Folks didn't necessarily care that the stock price sort of rose every quarter, right? This was not a dominant frame of thinking. Today, we think, oh, of course, it was always already like this, right? But these are historically contingent. And so part of what I want to do with finance was unpack it from a social and cultural perspective. And so it was sort of seeing the ways in which the short-termism and the pushing through of deals and the transaction-oriented mindset wasn't just, oh, it's just the market, but rather shaped by the larger institutional culture of Wall Street short-term employment, the constant revolving door, the fact that bonuses are based on quantity of deals and not its quality, or how well institutions do 5 to 10 years from now. So in a sense, by pushing through as many deals as possible, using the sort of moniker IBG, YBG, right? I'll be gone, you'll be gone, right, as a way to sort of extract, in a sense, the sort of most for that financial deal making, because they knew that they wouldn't be there for that long, and they knew that their bonus depended on how many deals they made, was really a recipe for the production of social, economic, and financial crises.
Wow. So the beginning of that, I don't know if you know this or if you checked us out at all, but my first 5 years, I was at 7 different Wall Street firms. My first five years in the industry. So fully aware of what that's like, and didn't find stability until I started my own company. And I'm so happy I did. Never backed away from that one. That's been great. But the idea of the next deal driving the next payday, protecting me from the insecurity of losing my job or the company going under or what have you, it's all very selfish. So I'm wondering, because you also write about the separation between Wall Street, the elitist culture, and the rest. That separation has to have, I'm going to take care of me and mine, beggar thy neighbor. I don't really care what happens to you and yours. Can you speak to that a little bit?
In terms of Wall Street investment bankers being selfish, it's not like I don't agree with that. But part of the what I'd like to sort of pick with is the way in which that is shaped through a larger socialization process. So, for example, even though Wall Street bankers and financiers are quite unstable in terms of their position, they're also the most highly compensated job category, right? In the U.S. and probably in the world. And this high compensation job category often leads to, or is often sort of based on their bonuses, which are, one could argue sort of windfall profits that are part of these deal making, and transaction sort of oriented mindset that they sort of help to push through. But part of this, their high compensation, is it oftentimes renders them and sort of shapes them in ways that they actually understand their precarity, right? Not in the ways that the average American worker does, right? Because even though Wall Street investment bankers are sort of notoriously precarious and have insecure jobs, they're also highly compensated. And so they often come to see job insecurity as forging one might call men of metal, right? Because they often land on their feet. They're oftentimes well compensated. They're oftentimes whisked off to a new position at a different investment bank. They're oftentimes highly sought after in a regular non-financial corporation because financial expertise is sought after, because finance is a dominant and predominant value. Right. So we need that expertise.
But let me get into sort of more like solution mode here. So I think like we really loved your critique. That's why we wanted to have you on the show. And I think that already like a critique is part of the solution because it brings into our awareness something of which we might not be aware. But if we turn this into like a more kind of proactive discussion, do you have any ideas about the levers we could pull on to start changing some of this stuff? Like if you had a magic wand, what would you like to see happen to fix some of this?
Wow, you asked the toughest questions. So I'll delay for a few seconds by approaching it this way. and the sort of strategic delay is that actually in 2008, we had a little bit of an opportunity, as well as a majorly unfortunate sort of set of cataclysmic events, right? So in 2008, Wall Street helped to catalyze, and one could argue without sort of much pushback that Wall Street institutions really did push the economy off a cliff. even though they were also then called upon to help save it. But anyway, that's a discussion for another matter. And in that moment, right, we really sort of faced a huge conundrum that I'm not sure I could that I wouldn't have been able to solve, right? So I'm sort of putting that out there. It's not like I knew the sort of, this is exactly where we should go with this. But part of the social safety net, especially in the US, being for so long outsourced to the financial markets, right? So everything from teachers' pension funds to larger savings, mutual funds, right? People's upper middle class Americans, Charles Schwab accounts, retirement accounts, being outsourced to Wall Street as opposed to pensions that were not as exposed to markets, is that that really, in a sense, empowered Wall Street to really command and demand a bailout. And so this bailout was in a sense enacted whole cloth. Right, trillions of dollars in terms of everything from the sort of Fed and the Treasury sort of shoring up, right, many of these institutions and the securities markets to, wholesale subsidy. And I think part of the opportunity that was missed here was an opportunity to reshape some of the really sort of short-term reasons and incentives that led to this financial crisis in the first place. And in part, right, it was a catch-22 because bailing out Wall Street also meant bailing out middle class and upper middle class Americans' retirements, right? So there was no sort of other source of stable retirement funds that was not tied to the markets, right? This has been in the works over the past 30 or 40 years where Wall Street was really empowered to be the advisors to all of these funds, right, which shaped their sort of growing influence, et cetera, et cetera. The other thing that we didn't do that could still be a possibility today is that we didn't actually bail out the folks whose homes were foreclosed. And I actually think that that was a big mistake, right? Because inequality has actually skyrocketed since 2008. And both for those at the bottom as well as for those in the middle. And it's precisely for those in the bottom and those in the middle that were oftentimes becoming homeowners for the first time in 2008. And actually bailing out Wall Street for all of its mistakes and I would argue a top-down pushing of subprime products, right? By 2007, most of the people who are sold a subprime mortgage would have qualified for prime. And I think that's a really sort of telling that there was a larger push here to sell more subprime, even though the homeowners would have qualified for prime. So the fact that the homeowners weren't bailed out, I think, was a sort of a really big misstep, right? It could have been sort of a homeowner's GI Bill that could have shored up some of that accumulated wealth that had been built over the course of the past 30 or 40 years that really disappeared. I feel like with 2008, we saw a place where we sort of lacked the political and economic courage, I think, to bail out the homeowners, which I think would have really reshaped some of the terms of the debate and the sort of political fraughtness of today, right? I think many of the sort of rise of reactionariness and alternative facts and I'm experiencing so much decline, I can't see straight, and what's real and what's not and what's truth. A lot of this we can sort of trace some of these underpinnings to social economic decline and precarity in the wake of 2008.
And that actually just got worse in the pandemic. I mean, we went into a brand new gear of precarity in the pandemic. And I think that, well, you should tell us, was the response there a better one?
When the pandemic first started, early 2020, the stock market tanked. Mm-hmm. And not surprisingly, the lessons that the financial markets learned from 2008 is that they would be bailed out. And so sure enough, the Fed and the federal and the Treasury kicked in terms of shoring up the securities markets again. right? On the order of billions of dollars, et cetera, et cetera. So
Trillions.
trillions, exactly, trillions. That there's an understanding there, right, of a competence that's actually not about necessarily free markets, but a competence that's actually made possible through subsidy. So, the stock market skyrocketing is because of investment, right, and governmental investment, not because of the brilliance of a trader or anything like that. In terms of what the pandemic laid bare, are the ways in which not only essential workers, but reproductive and care labor is devalued. And so reproductive and care labor being devalued, again, as we talked about, that's a cultural decision. The fact that GDP does not take into account reproductive and care labor is something that many historians and economists actually back in the day debated. Maybe we should take into account household labor. Maybe that would be a better measure of GDP, right? But what the pandemic really laid bare was that if we actually don't continue to devalue reproductive and care labor, then the house of cards really falls down. And that we could sort of no longer, in a sense, pretend that, oh gosh, some elves are doing the reproductive and care labor for us, right? That we sort of understood that for the most part, women, many people of color, essential workers, et cetera, really bore the burden of this reproductive and care labor upon which the economy was sort of was dependent upon. So part of that laid bareness and recognition really sort of shored up some of the pandemic-led safety net basic income reorientations, right? In terms of how do we actually think about issues of care and reproductive labor and essential work in ways that don't just elide them and depend on them and exploit them, but rather bring them into the picture. It's still highly unequal, but at least there's that recognition in terms of the importance of that work. So do you all remember when Goldman Sachs analysts early on, or not, maybe midway through the pandemic, posted their pitch book, right? And in the pitch book, these Goldman Sachs analysts talked about how much they're working 100+ hour weeks. They're working for much longer now in the pandemic than they used to be, and they were calling the sort of the senior bankers to task for this. And I was thinking this is actually a really interesting socioeconomic phenomena, because here you have sort of managing directors and senior bankers who, in a sense, are saving a lot of time because they're no longer out traveling, traipsing about, getting deals. They're getting deals, and so in a sense, they're really saving their travel time. Mm-hmm. They also probably have somebody at home helping them with the reproductive and care labor, right? So they actually have a lot of time to make phone calls, right? To get on Zoom meetings, to really drum up deals. And many bankers actually have told me that their deal-making pipeline during the sort of by the middle of the pandemic was higher than ever. They're making calls like nobody's business. All of this was falling on the analyst's lap, right? And of course, the analysts didn't have the, the plus side of actually hanging out with any other human beings, but rather was at home, right, dealing with all of the sort of, consequences of the phone conversations from managing directors who were stuck at home and had, lots of time to kill. But that's one way to sort of show that this was highly unequal. For folks who had resources, reproductive and care labor, as well as analysts, right at their beck and call, they were able to do quite a bit of profiteering, right, in ways that many other job categories could not.
So this is super interesting. We're going to have to start moving to wrap up, but yeah. I'm going to be selfish and just kind of like poke at this, reproductive and care labor thing, because look, maybe this is kind of, anecdotal, but one of the things I observed around me is that, like I have a young son. A lot of my friends have, young kids. And what I observed around me was basically middle-class women kind of got the rug pulled out from under them, because we all rely on these kind of pyramids of reproductive, like care labor, basically. But that like, it meant that the men in the couple, I'm stereotyping, but like they tended to be like, oh, well, I haven't noticed that there's a pandemic, like, oh, haha. Whereas like the women are like going crazy, back-to-back Zoom meetings, trying to look after the kids, like trying to do grocery shopping when there's like these massive lines. And I don't know, like other than getting knocked back 10 years in their, careers, I don't know that at least in Canada, there's much of a conversation about this. I feel like for sure the working conditions of like essential workers and, care workers here, there's more of a discussion about that. But I feel like, the kind of way in which like a lot of women live the pandemic, I don't feel like they're going to come out ahead with there being a whole lot more dialogue. I feel like they just had a very bad year and a half, and now they're trying to pick themselves up from it, having taken the hit to the career and da 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 da.
I think that was brilliantly stated. I totally agree. I mean, the sort of, at least sort of, many job markets, I think certainly in the US and probably also in Canada, and sort of really upwardly mobile jobs have embedded in it the sort of unconscious criteria that this sort of upwardly rising employee needs a wife, right? So the wife part, right?
Or daycare or reliable daycare. Like in Canada, we have cheap, affordable daycare for everyone. And that makes it that we have a female workforce that is able to move ahead in their career.
That's exactly right. That's exactly right. So all of this, upon what does this depend, right? That was shaped according to a particular narrow model, right? Really has been sort of unearthed. And at the same time, as you're saying, it might not be accounted for, right? We might not sort of deal with the sort of multiple layers of hidden and not so hidden infrastructure. The sort of, and the multiple labors involved, whether it's the second shift, right? The fact that daycare workers and teachers and other sort of, folks that reproduce what makes the sort of children, the household, work. All of that is not taken into account when we just think about the sort of normative worker.
A lot of this discussion of, let's say, the role of wealth and, financializing of things. I think we're socialized in such a way where we assume that success is coterminous with wealth and financial success. And so if I were to turn the question over to you, and maybe how you personally define success, or how you think what would be a more, socially responsible definition of success, how would you define true wealth if it's not financial?
That's a great question. I really love your podcast title about mindful wealth. And to me, what sort of mindful wealth captures or encapsulates is a willingness to think about not only what constitutes wealth and to question it, but also to think about upon what does my or others' wealth depend upon, right? So it's really thinking relationally, not being afraid to think about sort of history and inequality, right? Part of the piece on the sort of financialization of everything and the financialization of everyday life. On the one hand, I agree that that is something that is really occurring on a mass scale. On the other hand, I do want to make sure that we notice the differences, right? So for example, when we talk about really investing in living wage jobs, that doesn't mean that jobs or labor is not monetized or commoditized, right? It's still financialized at some point. But there are other values that are navigating with those values, that are negotiating it, that are thinking about the larger socioeconomic consequences. The sort of problem, I think, with a particular and singular focus on, again, a particular approach or interpretation of financialization is that it's not only extractive, but it's so short term, right? And part of what I think that your podcast is doing in terms of mindful wealth is really thinking about that question about extraction, right? Is to what extent, right? Upon what does this wealth depend upon? Whether it's in real estate and housing, or in the job market, or in finance, and to really be mindful of it, and then and to be sort of open not only to sort of thinking it in sort of new and alternative ways, but also to think about solutions once one thinks through some of those entanglements. I think also one of the hardest things for many of us is our own complicity, right? So, part of I might, for example, critique short-term shareholder value, but at the same time, as a university professor, right, I'm also seeing that my retirement accounts are part and parcel, are imbricated with and rising, right, due to a set of practices that focus on rising stock price. And those practices I might disagree with to the extent that some of the wealth has been redistributed from stable labor, right, or better sustainable arrangements to creating a quick dividend or a quick stock price spike that shows up in my portfolio. So I think part of thinking about wealth is to think about how we can engage with and open up these conversations about complicity. And also, Jonathan, this is to your point about, okay, well, given that many relatively powerful folks now, right, are investors themselves, how can we reshape that narrative and push back, right, in terms of what are shareholder values? And let's actually resist a narrow framing of that really has been dominant over the past 30 to 40 years.
I love it, Karen. I think that's a wrap. That's an excellent way to end a fantastic conversation. Thanks for being on.
Yeah, thank you both.